It's the home stretch. We're in our second to last lecture of Module 5. So let's see what we're going to be talking about. We've talked about the allowance for doubtful accounts, that ADA. So we're going to go a deeper dive into accounts receivable and the uncollectible accounts that go with that, because you don't expect to get paid 100% of what you bill. You wish you would. And if you didn't know that some companies are going to maybe file bankruptcy, going to disappear, or just not be able to pay you back for whatever reasons, then you want to be able to account for that at the time of the sale, not at the time when you discover they're not going to be able to pay you. So let's look at accounts receivable. And we have here our trade accounts receivable. There's that 8025, less ADA, allowance for doubtful accounts. And then it was 541 million in 2018. So say, wait a minute, 541 million, I don't expect to see out of that ultimate would have been 8 million plus 5, so it would have been 8.5 million. So I'm not going to see roughly $500 million. That's a lot of money, but you also again want to record that sooner than later to be accurate. Let's talk about agings for a minute. You can see here a receivables aging, and there's such a thing as a payables aging. It's nice to see a payables aging because you say, when do I have to pay in the next 30 days? I've got to pay this in the next 60, you pay this in the next 90. That's pretty cool. That's pretty powerful. But the same thing happens, when do I expect to receive payments from customers? Well, typically the current stuff, most of it comes in, but there's a whole bunch more that comes in 30 to 60, 60 to 90. And then as the older it gets, the less likely you're going to collect it. Often you will have a line of credit, or you will pledge your receivables, or you take out a loan based on your receivables. And the bank will say, well, current stuff, we'll give you a loan up to 75% of your receivables. 30 to 60 days, up to 50%. 60 to 90 days, up to 25%. If it's over 90 days, you're probably not going to see it. The problem or the challenge with that is what happens when your receivables become older, you don't have new sales making up for that in receivables, and now you might drop under the threshold of what you borrowed. And now you're obligated to go to the bank and say, got a problem here. I know you gave me $100 million and my receivables fell to a level, so my aging fell, and my calculation says 90. What can we do to renegotiate or accommodate this? And they may be able to call the loan immediately. And because if they say you think your sales are going down, you're not going to pay it back, it is the bank's money that they're trying to protect and receive. So we're looking at sales in terms of $100,000. And we have a 2.9% of that, $2,900 is in our allowance for uncollectible accounts. So what happens during the month? Well, at the end of the month, we calculate our bad debt expense. That's on the income statement. And we compensate by adjusting our allowance for doubtful accounts to go with that. And so we have a net AR showing up on our balance sheet, not at the total 100,000 for this of sales, but 97.1 of this, because there's an allowance associated 2.9% out of the gate. So what happens when a customer files bankruptcy? So we have our receivable, and then we have the allowance, which offsets that to get net receivables. But if we get a bankruptcy note, we don't expect to see that money. So there's $500 we got to take out of our receivables. And there's a corresponding $500 that we adjust on our allowance for doubtful accounts. So any transactions during the month, sometimes our allowance is going to go down when we get notice that we're not going to get paid, or we discover, return to sender, we get mail back, or bills come back, and we're not going to see the money. The corollary is what happens if we get paid money. Just because you get a bankruptcy notice doesn't mean you're not going to see any of the money. Maybe we recover 40%. 40 cents on the dollar. So in this case, 40% of 500 would be $200. So we get a check for $200 in the mail. That's gravy. Thank you. What happens? We get cash at 200, and we offset that by increasing our allowance for doubtful accounts during the month. And at the end, we use that percentage, and maybe it was a 2.9, maybe we're adjusting it to 2.5 or 3.0, but we're going to use that percentage at the end of the month and then adjust our bad debt expense. So that's logistics. We only expense this stuff at the end of a time period. We do not during the month expense it, because that's what the allowance account. The allowance account is our cushion. Allowance for doubtful accounts is a way of moderating that adjustment. And then at the end of the month is when we take full account of that. So let's look at some of the ratios that go with this as well. Well, we've done the receivable turnover before. We know the income statement item for the year is divided by the average balance sheet item called average AR. So if we've got $100 million in sales and our average AR balance is 10 million, well, we get 10 turns over the year. That's on average, every 36 days, we get 100% of our receivables paid. By the way, another good way to remember this is to know which is the numerator. You say receivables turnover. I know receivables is one of them things in there, and sales. By the way, when we do inventory turnover, we know inventory is one of those things in cost of goods. I'm going to ask you, which is the bigger number? Is sales bigger or is accounts receivable bigger? Well, hopefully sales keeps going up, 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 and receivable goes up and down, up and down, up and down as sell stuff, pay stuff, sell stuff, pay stuff. What's going to happen? You put the bigger number in the numerator. Bigger number over the smaller number, 100 million over 10 million gives you 10. Now we got the number of turns in a year. And by the way, inventory turnover, which you're going to need to know, inventory is the same way. Inventory keeps going up, down, up, down, up, down. Cost of goods sold, in theory, should be going up, up, up. Cost of goods sold in the numerator, average inventory denominator. So it's not a bad way to remember it, because I am going to be asking you to remember some of these ratios. Actually, all of these ratios, but most are intuitive. But now we divide that 10 that we calculated by 365 days. So 365 days divided by a ratio of 10 yields 36 and a half days. In this case, for Pfizer, we've got 6.6 times. So about every 55 days, almost every 2 months, they're 100% receivables turnover. That doesn't mean all receivables get paid. It means on average, all receivables get paid. There's some that are going to go 70 days, 80 days, 90 days, never. Some are paid in 10 days. Some are COD. So this is the average to go with that. So how do we interpret some of these ratios? When accounts receivable have grown very quickly, lower receivable turnover. So again, the sales in the numerator, high percentage of accounts receivable to sales, length of DSO. We analyze and say, well, what two numbers are going to affect us here? If we reduce our accounts receivable, we're going to get a higher turnover. If we increase our sales, we're going to get a higher turnover. Them's the rules of math. Okay. So generally, when we have accounts receivable turnover, trend is not favorable for two possible reasons. More lenient in granting credit. So our sales are rising, more credit sales it is. Again, by the way, one caveat, when we see sales revenue, these ratios assume all sales are credit sales. Say, no, I'm Walmart, I'm a restaurant, I'm a retailer, I'm Lowe's. And you're right, those are not mostly credit sales. So these numbers can be deceptive. So we need to account, this is mostly business to business, B2B, we're going to have mostly credit sales, not cash sales. So if we start giving out credit willy-nilly or being more lenient, chances are we're not going to be in a better position to collect those monies because we're now saying, you know what, we're desperate for sales. So we're going to go ahead and grant credit to this other company that we're not sure how financially stable they are, but it's a sale, right? And my bonus is based on my sales. So I'm going to go ahead and make that a sale, get a receivable. And then as sales rise, we got to take a closer look, a deeper dive to make sense of some of this stuff. So let's look at receivable turnover. Again, the absolute number, 6.6, doesn't mean anything. But an accelerating trend to turnover, meaning less days, is typically a good sign. So we look at from 2014 to 2018, we go from 5.6 to 5.9, 6.4, 6.6. We're collecting our receivables faster, is the message that's sending. From 65 days over 2 months to under 2 months at 55 days. Okay, and then we'll worry about inventory and payables another time. So increase over the past 5 years, good sign. So that's a positive trend. Can it be, well, what can happen? If we cut down our receivables in half, we're going to also grow that trend. But if we're cutting our receivables in half, maybe we're getting more tight. We're not granting as much credit. And if we're not granting as much credit, of course, we're going to have smaller receivable sales. But if we have small receivable sales, we're going to have smaller sales in general. So that might ultimately adversely affect us. So and again, declined by 10 days from the 65 days to 55 days. Basically, faster cash flow is typically good, but it can be going to an extreme. 2 more slides to go. Let's take a look at AR quality. Okay, so we roll forward, we do some analysis. We can see the changes, deductions on the allowance account, and the balance at the beginning, balance at the ending period, and then we calculate a percentage. The percentage, as you can see in 2017, 2018, we have that allowance and what as a percent of the gross accounts receivable. It's going to fluctuate. It's going to change. It's not cast in stone. It is something, though, that you want to review and be aware of, because fraud can take place here too. People can say, well, why don't we make it just 1.75% instead of 1.84 or 1.5%? And now it's going to yield higher net income because that's a lower bad debt expense, which means ideally that you're collecting better, but it also means you're just cooking the books. And then we have quality, AR quality, 2 possible interpretations on the trends. If we look at what we had Levi Strauss previously, remaining receivables have improved, can feel confident allowing allowance for uncollectible accounts to decline, or is underestimating the allowance account, which is more troubling. So that gives you some perspective on when you might use some of the stuff. And it's pretty powerful to be aware of as we analyze financial statements. Thank you for listening. Thank you for sharing. And we will look forward to our next encounter.